Malbang, ladies and gentlemen, I'm Hiral Datia. We have with us Mr. Murli Ramakrishnan, MD and CEO at South Indian Bank, joining in. Welcome to the show, Mr. Ramakrishnan, and a pleasure to speak to you and get insights from you.
Thank you.
Mr. Ramakrishnan, my first question coming to you is, interestingly, we've seen a major improvement in the last couple of years with the Indian banking system. And in fact, the sector has recorded the highest profit in the last 26 quarters. Is this the peak for the industry, or this is just the beginning according to you?
I think the way the whole banking system has been focusing on improving the quality of their portfolio was quite visible over the last few years. Thanks to credit bureaus, etc., coming in, and most of the banks were focusing on retail as one of their big areas of growth. As you know, between 2012 to 2015, 16, etc., corporate banking had a great run. And but subsequently, due to COVID and other situations, etc., many of those banks which were focusing on corporate wholesale banking, they had a difficult time in terms of their delinquencies going up. But many of them shifted to focusing on retail, and with the advent of bureaus, etc., the quality of retail book which was getting built by all the banks were fairly pretty good, I must say. And today, if you look at, many of them have actually built a very balanced portfolio. So to that extent, I think what has happened during this period, during the COVID period, anticipating that the portfolio will have an impact, many of them actually started proactively providing also for more, anticipating that there could be an issue in terms of recovery and collection. But quite contrary to everyone's expectation, when economy started reviving, etc., the slippages weren't as bad as what everybody thought it would happen. Therefore, to that extent, I think slippages were less, and whatever was provided proactively, they could bring it back, and that has resulted in numbers showing up very well. That is on one side. And I think the second most important point is also that the pricing challenges which the market had, particularly for across the banking, across the various sectors, the corporate banking, SME, etc. I think there was since the pricing was quite fine, I think people were clearly focusing on getting quality assets. So to that extent, the book which was getting built, though it was in terms of growth, it might have been little lower than what otherwise you would have seen. But I think the composition of the incremental book which was getting added was quite good.
Right. So overall, if you see from here,
so from now on, what we anticipate for the Indian economy is that it will definitely, we have started seeing signs of it getting revived even in the first 2 months of this year. If you look at it, I think the credit offtake has been pretty good. But however, having said that, I think there is this due to the inflationary pressures and due to the global scenario of a war continuing, etc. Clearly, there is a need for regulators to keep revising the repo rates, etc., which will definitely mean that the banks will have to constantly tweak both their deposit rates as well as their lending rates. So thanks to the situation that most of the loans are today priced at the external benchmark. So the moment these rates get revised, banks are able to pass on most of it to the customers, other than probably very choosy AAA customers who might still demand very fine rates. But by and large, I think the banks will be able to pass on the increased interest rates which is prevailing in the market. Though we expect that rates will further harden up as we go along, I feel the bank's ability to pass on this is pretty much there due to the clearly transparent way of pricing, which is linked to the external benchmark. So my sense is that if the economy, if no other shocks come, like COVID again doesn't resurface into a serious situation, etc., I feel this year would definitely be a much better year compared to the last year, because in the last year, if you look at till September, we had a COVID-2 impacting the entire banking system, which I feel won't be there this year if COVID doesn't really interfere in the economy. And with that, I expect the entire banking system to really come back with a bounce this year.
Right. So overall, if you see in terms of, the asset quality as well, a lot of support that the RBI had given has now started to wean off. How is the banking sector viewing it? And because of that, do we see any constraints on the asset quality and the provisioning front?
I think the answer for this would be, I would say it will be mixed because if you really go into the details of how the central bank had facilitated many of these SMEs and the retail who were impacted by COVID is by coming up with the various COVID schemes wherein we gave them moratorium for 1 year or 2 years, depending on the scheme. And many of them are actually will be becoming due in this year. The first COVID one probably it's already now on, but there again the subsequent COVID schemes have made banks to give more moratorium to those eligible cases, etc. So we will see the impact of those in this year and in the coming year. But having said that, since the economy has started bouncing back, many of the SMEs and retail who were impacted by COVID, their situation definitely has turned out to be better than what they were earlier. And they are now able to see their business models coming back into shape. If you look at even the GST data, etc., today we are finding that they are able to meet up with the projections which they had provided when they came in for restructuring. So with that, I believe that their business models are now turning out to be viable, with the result that people who have actually had a good business model, which temporarily got impacted due to COVID, they're able to come back. But there are businesses like, for example, tourism, etc., which were badly impacted due to COVID. And it will, in my view, it will take some more time for these sectors to really come back because it calls for discretionary income with the consumers for them to revive, to go back to tourism and picnics, etc. It will take that much more time. And but there again, if you look at hotels, etc., you are finding the occupancy rates, the capacity utilization, they're all on the rise now. So I think we will definitely be seeing revival of a fairly good number of sectors in the coming year. But I won't say that it will be uniformly applicable to everybody. So people will have to really tweak their business model to be in tune with what is currently required for them to survive and to grow.
So overall, if you see in terms of where interest rate goes, now that we know we've already seen 2 rate hikes by the RBI, what's the kind of impact are we expecting in terms of deposits as well as disbursements and lending?
Yeah, I think what central bank had done is pretty much in tune with what we were all anticipating, that that's what they would do. Because when we clearly see that inflation is on the rise, and even when they had come out with a surprise announcement when they in early May, when they had the data for March and April, we knew that we all were anticipating that the rate hike is going to happen. It's just a question of how much and by when. So people were anticipating the rate hikes will happen immediately, but how much was the only question. And it is now fairly clear with the inflation expectations spelled out by central bank over the various quarters of this year. We clearly feel that already we have had to see impact of 90 basis points going up from the 4% rate which was there earlier. We with the inflationary expectations around, let's say, 6.5 to 7% over the year, I anticipate at least another 100 basis points increase by the end of this year. That's what I think will happen over the next, say, 8 to 9 months by the end of March of next year. So the impact of that obviously would be reflected in the way various alcos of the banks will revise their deposit rates, depending on the appetite which they see in terms of their own growth in their portfolio. I'm sure each bank will have its methodology of tweaking their interest rates, deposit interest rates. So is our bank. So we are also clearly revising our deposit rate so that it's a need of the hour. Otherwise, deposit holders will actually have a need to return for the money they keep. With the inflation at 6-7% and their interest rates, deposit rates at 5.5 and 6%, they'll clearly be having a negative income. So we need to really tweak those rates in order to continue to keep them as our deposit holders. As far as advances, loan side is concerned, as I said earlier, it's all linked to the external benchmark. So clearly there will be a passing on effect of rates to the consumers. I'm sure most of the consumers will also be anticipating this. Therefore, with the rates having been very low in the last couple of years, in fact, I would say in my 30 years of this, I've never seen rates going down to as low as 6.5-7% for SMEs, etc. So now probably market is pricing to the risk which this customer segment is really wanting. To that extent, I think passing on of these increases will happen to the to the loan customers.
Right. So overall, from here on, if you have to look at, your bank as a whole, what's your view on the asset quality front from here on?
As far as my bank is concerned, we are in the journey of addressing our the legacy issue of our portfolio quality, which we to a large extent we are bringing that under control. In fact, the recovery and collection, we have done some record recovery and collection for the year which just ended, which was almost 2.5 times of what we did the year before. And with the same thrust on upgrade and recovery happening in the coming year, with economy supporting, I'm sure we'll be able to bring down the slippages happening in the portfolio. And the good part, as far as our bank is concerned, is that the incremental portfolio which we have added over the last 18 months is of very, very good quality. And therefore, I don't really see too much of slippage happening from there. So with the legacy book quality getting corrected and with the incremental book not really giving too much of a problem, we expect that over the next 12 to 18 months, we'll be seeing a very decent slippages from the exact higher levels which we experienced in the past. Last 2 years as a bank, we experienced quite a good amount of slippages, close to 4,300 crores in 2 years, which I'm sure will come down drastically over the next 18 to 24 months.
Right. And overall, if you see in terms of the provisioning, how is that looking like?
We have consciously improved our provision coverage ratio. I mean, if you're asking about our bank in particular, we have improved our provision coverage ratio from what used to be sub 60% to close to 70% now. And even if you exclude the write-offs, etc., we were at about 32%. We are now currently at 52%. So the endeavor is to take it to 75% plus levels, including write-off, and excluding write-off, I would probably target 55 to 60% as a first milestone and then improving further. The well-run banks are currently at about 70% level. That's what we will probably aim to reach over the next couple of years. That's the game plan as far as provisioning is concerned.
Right. And overall, what are the segments that will be a focus for a South Indian bank from here on?
We have been articulating that we are looking at quality assets across all the segments. So this year, we really foresee that a lot more opportunity will be coming up in the corporate banking space too. Earlier, the strategy of the bank was to really diversify the risk and go into more and more of retail and SME. But COVID situation and the last 2 years of impact of COVID on the SME customers as well as the retail consumers, we haven't really seen SMEs coming back fully into shape, though they are all in the various paths of revival. But we still feel that the sector is still to come back to its original form and shape. Therefore, we will continue to be very choosy about picking up quality assets both in retail and SME. As far as corporate is concerned, as you know, well-rated corporates have plans for going in for more and more of investment, and we're actually seeing them setting up projects, etc., anticipating that the demand is going to go up. So we see a lot of opportunities coming up in the infrastructure and in the corporate banking space. So our focus has been to churn our book into making it more and more a better quality book. And I'm happy to say that almost 85% of our incremental assets which gets added in corporate are of rated A and above, externally rated A and above. So we will continue to focus on quality assets as far as corporate is concerned. So we are pretty indifferent. Wherever opportunities are available for good quality assets, we are going after them. So in retail, if you ask me, the focus will be to improve our unsecured, where we are almost non-existent today, where we will be giving focus to grow that book. And we will certainly look at home and mortgages, which is an area which gives a lot of stability to your portfolio. And as far as SME is concerned, lower end of SMEs, where the ticket sizes would be typically, let's say, average of 1 crore, where it's largely dependent on the collaterals, etc., which we collect from the customers. There, I think we'll continue to focus on rating models, etc., to underwrite cases in that segment. So the focus will be on quality combined with the growth is what I'm going to be doing for our bank.
Right. And very lastly, how big is digital banking a part of the growth strategy for you from here on?
So, no, it's pretty much integral to our growth. In fact, as a bank, we have done very well as a technology in the area of technology. In fact, our bank has won 6 out of 7 awards in the recent IB Awards for technology amongst the banks, amongst the various banks of our size. In fact, in some of the categories, we have competed with large banks also, and we have won prizes over there. So, technology is very, very strong for us. Our internet app is a very, very powerful application we have. And even across asset products, we are going in for a retail platform, which is almost at the last leg of it's getting implemented. We are going in for a SME platform for digitizing the entire SME business. With these platforms, the advantage is that we can digitize the entire journey of loan processing from sourcing till collection and recovery. And even in the area of supply chain financing and vendor financing, etc., we have gone in for a latest platform. So almost in every product line, in treasury also, we have gone in for a new treasury system. So almost every segment which you look at today for banking in our bank, we have gone in for technology. We have gone in for investments in technology area to make it digitized. And we are pretty much there. And I'm happy to say that it's pretty much integral to the part of the strategy which I have articulated for the bank. So it's going to be playing a big role.
I think the space as a whole, the banking sector as a whole, seems to be in a much better space as well than what we used to see a couple of years ago, and the growth story remains intact from here on. Thank you, Mr. Ramakrishnan, so much for joining us on the show. Always a pleasure to speak to you, get insights from you. Congratulations once again for this outcome, and good luck for the coming quarters and years.
Thank you so much. Thanks for the opportunity. Thank you so much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.